All right, let's see. All right, Chris, so I see that you've got a question already. We're going to come back to that in a second. I'm going to give Heather a chance to say hello before we start asking questions. They're very anxious, Heather. But Heather, we were talking a bit about your background and some of the work you did for these larger companies. Why don't you tell us a little bit about yourself and how you fell into this specialization in Social Security planning?
Yeah, I've been in advanced planning we were talking about it, I guess it's my 28th year. And Social Security became a passion of mine, along with all the things that you study and are passionate about with respect to the Master Elite Group. Retirement income planning is just a passion I have. But about 12 years ago, I guess when the baby boomers, started to approach retirement, I realized that Social Security, obviously being sort of the base of most people's retirement, was so convoluted and complex, but yet such an important part of that puzzle. And no one really understood it. And I'm talking about a lot of financial professionals that were helping consumers, and a lot of consumers were trying to navigate it themselves. And so I was thinking, you know what, someone needs to understand this, because the reality is Social Security, the representatives that take these claims are strictly prohibited from engaging in anything that appears to be advice. In fact, they have the Bible, per se, of Social Security's, procedures. It's called the POMS, the Program Operations Manual, and it is frightening. For people like me, it's still sometimes frightening. If I'm trying to find exactly how they handle a certain thing, it can send you over the edge, even if you're a techie like I am, where I love looking through tax code, but they have procedures for every single thing. And one of their specific guidances that says, do not engage in anything that looks and appears to be advice. You can answer questions so that someone can make an informed decision.
Yeah.
So that became sort of like, okay, well, if you don't know what you don't know, how can you possibly know whether you are making the right decision, right? And a lot of financial professionals are like, well, this is a scary thing. It's an important decision. I don't know enough about it. There's so many twists and turns to it. Now, 2015 was sort of a significant year for Social Security, because when the budget was going through, they slid this little section of the budget that basically took away two strategies that were considered crafty strategies that helped married couples get more out of the system. It wasn't illegal, but it appeared to be. It was like, you're taking more out of the system than you should be. So those strategies are one of them was eliminated pretty quickly. One still exists for a small handful of folks that are turning 70 by January 1st of 2024. But there's still, even with that gone, it's so important and so much to know about it. Even more so now that the strategies are gone, it's still such an intimidating decision. It's kind of like, when people are lucky enough to get a pension, which, we know those are further and further being lessened, unless you're lucky enough to be, a government employee maybe, or something like that. But no one just takes does this and looks at their pension option and, does it. It's kind of the same thing. Social Security is a pension. And so it's really an important decision. So that is the long-winded version of why I decided that I was going to become a Social Security nerd and learn it all, and then teach everyone about it, because it's just so important that we teach the consumers about it,
Yeah, it is such a big decision. And there's also so many helpful experts out there, your brother, your cousin, your barber, your neighbor, who have so many opinions. And it can be really overwhelming and confusing, because there's a lot of fear around making the wrong decision, because it is revocable to some degree, right? There's some things that you can do certainly within the first 12 months, but and then we were talking last week about being able to suspend benefits, but but it mostly is an irrevocable decision after a period of time, right?
It is. It is. And, I always call it water cooler Joe. Water cooler Joe always knows what the right thing is to do. And, and there is an emotional component to decision, without a doubt. And the one overwhelming one I hear is fear, right? Oh, it's not going to be there. Right. And we hear that a lot. And I would, you know, I don't have a crystal ball, but you know, it's going to be there. I don't think that, you know, fear should be an overwhelming reason why someone runs down to take the benefit. Should it be something that we should listen to? Absolutely.
Mhm.
You know, but it's a system that's been in place since 1935, and
Yep.
no politician's going to say we're going to get rid of that.
Right.
You know, so it's something that really consumers really need to sit down and say, okay, let's look at this along with everything else we have. I always say you cannot look at Social Security and the decisions about how to claim, when to claim without looking at everything. That's the most important thing. Anyone that is advising you that says, well, everyone should do this, everyone should wait till 70, run. Or if anyone says the opposite, everyone should take it at 62 because it's not going to be that, run away from them too, because everyone is unique. I can't possibly tell you without looking at the whole scenario.
Right.
You just can't. It's so unique. It really is.
Yeah, that's a great point.
Yeah.
That's a great point. One thing I forgot to say was a lot of people are going to watch this on YouTube. So if you're watching this on YouTube, be sure to hit the click the like, subscribe, and notification button. It's amazing how many, you know, these webinars, it's amazing how many people just find us on YouTube, especially when we're talking about Social Security. So we'll have to loop that back in the beginning to remind people to do that. And I told everybody that you folks are muted. Obviously, we're not. We're hoping that you can hear us okay. And I know you were notified, but I just want to remind you that we're being recorded. You know, tonight is one of our special webinars, and we do these periodically throughout the year. But every week, I hold a live weekly webinar at 10 a.m. on Tuesday. So you can find the links or recordings of previous weekly webinars and register for our weekly webinars on our webpage, attleborowealth.com. All right. So Heather, we talked about a few questions that when you and I talked in preparation of this, we said, what are some things that we might want to focus on? And one of the things that you mentioned was talking about why working and making a claim may cause more than a higher tax bill. And, you know, some of the things behind that. And a lot of people don't realize still that your Social Security can be subject to tax, which is surprising to me, right? But you know, it's this odd calculation called provisional income that really doesn't, it's not based on adjusted gross income or modified adjusted gross income. It's got its own calculation, and people are often surprised about this. And sometimes people who you think should know, right, are often surprised by it. So why don't you talk about that a little bit for us?
Yeah. So a couple things go into, well, there's a couple things that get confused a lot. So in fact, can I share my screen for a second? Let's kind of talk
please.
about a couple of things.
Yeah.
Let's see. Okay, here we go. So let's talk about a couple of things. I'm going to step back for a second before we even talk about taxes and tell you where I see a lot of people get confused. So when you claim a benefit, there's two things you got to think about. Taxes, and people think, well, wait a minute, I pay to get in, I pay when I'm paying into the system. What do you mean I got to pay when I get out, right? That's one thing. So we'll talk about that in a second. But when someone is considering filing for benefits and they're under full retirement age, and full retirement age is different for everyone based upon your year of birth. So if you're under your full retirement age, and hopefully you know when that is, if you're born in 1960 or later at 67, if you're born between 1955 and 1955, it's some iteration of 66 plus 2 months, 2, 4, 6, 8, 10. And if you're born in 1954 or earlier, it's 66. Okay. But if you're trying to take a benefit before your full retirement age and you are working, here's the first thing I want you to know, because this gets people. And for some reason, Social Security, well, I can probably guess why, but Social Security is sort of on a rampage to find people that are getting excess benefits. They're called overpayments. So you want to be mindful of the first thing. So if you are considering filing for benefits before full retirement age and you work, you can only make a certain amount of income before Social Security says, time out, you have income over the limit. We're going to start withholding some of your benefits. So in 2022, if you're under your full retirement age for the whole year and you earn more than $19,560, then that excess income over that threshold will cause $1 for every 2 over that limit to be withheld from your benefit. So let's suppose that you're $10,000 over that limit. Social Security says, well, we're going to withhold the first $5,000 of your benefits before we pay $1. So when you file for your benefits, whether you do that online, which is usually the easiest way to do it, or you take a chance and go down to the local Social Security office and wait. They ask a lot of questions. How much do you anticipate working? Are you retired or whatever? If you're retired, it's fine. But if you're working and you think you're going to make more than that, they're going to withhold benefits. And they withhold them from the beginning before they pay a dime. So if your benefit is $1,000 a month, let's just say, and they're going to withhold the first $5,000, they're going to withhold the first 5 months of benefits before they pay anything. So that's number one. You need to be mindful of that, because people that don't let Social Security know that they're going to be over the threshold and Social Security goes ahead and pays, trust and believe they will find you, because they come back, IRS communicates with Social Security. So the following year, and it can take a while, they can not catch up with you until October of the next year. And then you get a letter that says, guess what? According to the IRS, you made $10,000 over the limit. So therefore you owe us $5,000, for example. So you don't want that to happen.
Right.
In the year that you turn full retirement age, so the months leading up to that, the limit's higher, right? So in 2022, that limit is $51,960, and they're kinder. They only withhold the first $1 for every 3 over the limit, okay? Once you hit full retirement age, so the month you hit your full retirement age, this annual earnings test no longer applies. So this working and claiming a benefit only applies if you're under full retirement age. Common questions. What if I'm fully retired, I want to take my benefit early, but my spouse is still working? I'd say no problem. They're not going to withhold based upon your spouse's earnings, but what might happen? It might be taxable. So is it a good idea? Because you're going to take a permanently reduced benefit. Anytime you take a benefit before full retirement age, it's going to be generally permanently reduced. Now you got to say generally about everything, because isn't there a caveat to everything in life? You could do a withdrawal of application within the first 12 months once in your life and pay back all the benefits. Not many people do that because you got to pay back all the benefits, but there is always an exception. But the point is, you have to be mindful of this. What doesn't count as earnings? Common questions. Unemployment benefits don't count. Pension income, rental property, IRA distributions. You get the drill. It's truly earned income. Alimony settlements after 2018, that's no longer considered earned income. So that doesn't count. Your spouse's earnings. Again, if you're filing for an early benefit and you're retired, you're fine. Even if your spouse works, you still might have a tax problem, which I'm going to talk about next, but you won't have a problem here.
Yeah, let me just jump in there for a second, because I can see some confusion already. So what Heather is talking about is the reduction of benefits and what doesn't account as earnings, because all these things count towards earnings for taxes, for more and more and more and more. So I don't want anybody to be confused by that.
Yeah, and that's why I'm kind of talking about the two concepts. So first, we're talking about the earnings test for pre-full retirement age claims. So basically what I say, if I have a rule of thumb, if you're working and you're trying to file for benefits early, I usually try to discourage it unless you're making way under the threshold, because you don't want to get into this mess where they start withholding benefits, in my personal opinion, because you're not getting the monthly income you need anyway. They're going to withhold some of your benefits on the front end. Now, when they withhold benefits from you because of excess earnings, it isn't truly lost. You do get the income back, but they don't pay it back to you until you hit full retirement age. So let's say you get the equivalent of over time, 10 months of benefits withheld from the time you're 62. Let's say you filed at 62 and you hit full retirement age and they've withheld a total of 10 months of benefits. Then they'll recalculate your benefit at full retirement age to calculate back in those 10 months of missed benefits. So your benefit does go up once you hit full retirement age, but it's still, it's not ideal if you're trying to plan for monthly expenses and have benefits withheld. I know we're getting questions. So let's go over the earnings limit again. The devil's in the details. So remember this, the earnings limit only applies until the claimant reaches full retirement age. So remember, once you hit full retirement age, don't even have to worry about this anymore. You can earn as much as you want, not have to worry about this pesky earnings limit.
And can I interject one more time? Sorry, go ahead.
No, I was going to say, taxes are the gift that can keep on giving forever. But for purposes of worrying about, oh, can I still work and not worry about them withholding part of my benefits, this goes away at full retirement age, right? Some people say to me, okay, well, what happens if it's now, what month are we in? October, I've made $50,000 this year. I'm 62. I really want to retire to replace that income. But according to this, I've already made way over 19,560. Do I have to wait until next year? And the answer is no. If you retire mid-year, Social Security gives what's called a first year of retirement rule, or the monthly earnings test. And what that means is they'll say, we'll totally disregard all of your earnings up to the month that you file, as long as you make less than the monthly equivalent of that annual limit. So what's that mean? That means if I take the 19,560 divided by 12, whatever that comes out to, 16 something, as long as you make less than that for the rest of the year, you're fine. So they'll just totally disregard this. And this is for people that obviously say, okay, well, I've just retired, I need a replacement income source. They're going to let you do that, right? That's what that means. And again, like I said, when you do get benefits withheld because you've earned too much money, they will pay it back to you in the form of a higher monthly income benefit once you hit full retirement age. So they aren't truly lost, but it's kind of a headache when you're trying to plan for income, when they start withholding full months of benefits to account for that. And then the other thing I was going to say is, even if you can file for benefits because you're under the limit of the earnings test, it still can be not the best choice, because even if you still got earnings, it could cause a portion of your benefits to be taxed, which is what we'll talk about in a second. I don't know, Mark, if you have anything that you would add to that in terms of what you talk about with your clients, or I don't know.
No, first of all, let me say a couple of things. So the full retirement age can be confusing for people. So I always recommend people go to ssa.gov and set up their online profile. I can't remember when they stop, or we used to all get the statements in the mail, and now you only get them in a small window, right? Do you know?
Yeah. So they started pushing less and less, the Paper Reduction Act, it was like 2010.
Right.
So now they're encouraging everyone to have a My Social Security account, and I encourage everyone to do it. If you don't have one, you should have one. So what they do now is, if you do not have a My Social Security account, you will start receiving paper statements when you turn 60, and you'll get one every year about 3 months before your birthday. If you have a My Social Security account, you won't get one in the mail at all. And you can request one, but you won't get it automatically. But it's really important to have one, because you need to be checking your earnings, especially if you're a business owner.
Right.
Anytime, you really just need to be checking to make sure that they recorded your earnings accurately. I mean, I've heard people call me and say, they haven't recorded my earnings for years, and they're only finding out about it because they just got a My Social Security account. And there's great tools on that account as well. You can, finagle your earnings. What if I earn this instead of what they're projecting my earnings to be? Because Social Security benefit computations or estimates are based upon your most recent year of earnings. So let's say you are a business owner and you want to show, well, I might not earn that. What if I change my earnings to be this? There's ways to do that in your Social Security, your My Social Security account. You can go in and change what your Social Security taxable wages will be to figure out what that would do to your benefit. Or let's say you're like, well, this is predicting that I will continue to make $50,000 until 62, my full retirement age is 70. What if I decide to retire at 55, for example? They're not showing that. You can do that on your My Social Security account and even download all of your what if scenarios. So highly encourage everyone to do that, just for all kinds of reasons.
Yeah, you just can't rely on somebody else to be accurate about your information. Right. And so that's important.
Right.
Do you want to pause here and take a couple questions?
I love questions. Let's take some questions.
All right. So an anonymous said, I always love the anonymous. You said an option of waiting until age 71. I thought it maxes out on your 70th birthday, or do you have to wait until the end of the year?
So I'm sorry, I was reading the ones that I can see.
That's okay. This person heard you say you have an option until waiting until age 71. So she's saying, I thought that meant that it maxes out on your 70th birthday, or do you have to wait to the end of the year? Now, honestly, I don't know if I heard you say that.
I didn't. If I said that, I don't think I said that, but you should never wait beyond 70.
Right.
I don't even think I don't even know if I said that, rewind and do over. Never, ever, ever wait past 70
Yeah.
to take your Social Security benefit. And believe me, I have heard people say, oh, well, I was still working, so I'm 73. I never took it. And I'm like, well, you just put money back in the trust funds that you'll never get back, because the most you can ever request of retroactive benefits now is 6 months.
Mhm.
6 months or back to full retirement age, whichever is less. Okay. Never go past 70, because your delayed retirement credits, which are equivalent to 2/3 of 1% every month, which if you do the math is 8%, that's your 8% per 12 months, stops at age 70. So I apologize if I somehow said 71. I don't even
I
know.
don't think that's the case, because I didn't hear it, but this person heard
Okay.
it, anonymous.
Okay, well, what we
Heard it.
clarified it anyway. Never, I always say, never go past 70. You do not get brownie points for, being
I think
start
that's a
people in
great
that
point.
case.
Yeah.
Yeah. What about, are there other ones? I'm looking at the chat. I'm seeing an anonymous attendee about the COLA. Should we do
Yeah,
that?
how about so Chris sent a letter or a question in right after we started. So how about we read his?
Chris?
Uh,
Okay.
Yeah, don't read
By
the
law.
last name because I don't know.
Okay.
I
By
don't know if
law,
you
the
know.
Social Security benefits will be reduced by 20% if it becomes insolvent. When planning for retirement, should we base our calculations that it will be fixed or based on 80%? That is an amazing question, Chris.
Amazing
And yes,
question.
so the most current Social Security Board of Trustees report does in fact say exactly that, that if nothing has done to change the current project, the current situation with respect to the trustee or the trust funds, that there would be enough in the till to pay with ongoing revenue to pay 80% of promised benefits. So that's the question. I think that there will be changes made, but to me, yeah, I think that certainly making a what if scenario working, Mark, I don't know how you deal with this, but I personally think it's worth the conversation to say, okay, what do we do in worst case scenario? If
Mhm.
this does in fact happen 13 years from now,
Mhm.
that we have to reduce benefits by 20%, how are we going to solve for that income bridge?
Yeah.
I personally don't think it's going to happen, but I do think that it's worth having a plan. Everything has to have a plan. So what do we do if that is the case? How do we solve for that potential reality? I personally think that the changes that will be made will be the workers, that it will be the current workers in the system, increasing the taxable wage base. So right now we're at $147,000, and then the Social Security tax is stopped. The current administration is talking about reinstituting it at 400,000 for singles, 450,000 for married. That to me is something that I could see happening, increasing full retirement age. But I think really the ways to increase it would be on the workers more than it would be shaving benefits from people that are in the system. I just think that is politically not the right move. But having said that, I think that it's worth, having plans put in place. Mark, what would you say to that?
Well, I'd say it is an amazing question. And Chris has either been on a lot of our webinars or he does his own research. So every year there's a Social Security and Medicare trustees report. The most recent one was released a couple months ago. And this window gets smaller and smaller and smaller every single year, right?
Yep.
So, and Medicare is worse, by the way. Medicare is basically right around the corner. I usually have those notes in every one of my webinar notes, but I think it's 2028. So Chris could probably tell me when it is, which is tomorrow, basically, when that trust fund is depleted. So what Chris is talking about in 2035, it's projected for the Social Security trust fund to be depleted, and I think it's actually 77% of the benefits that will be able to be paid. So I do think you're right.
This is the combined trust funds, is what he's.
Oh, Social Security and disability, then.
Yeah.
Yeah, that makes sense. So I think that you're absolutely right, Heather. I think that Congress doesn't have the guts, because they're, the House of Representatives and the Senate, they have these election windows, and that's really where their blinders are. And we see it every single cycle There's very few bold people who will go out and say, because really mathematically, the thing to say is, on certain income earners, we cut benefits, or with my generation, right, the X generation, I think it's likely that we're going to see maybe our earliest claiming age might be 67. And then full retirement age for me for Social Security might be 70. And then maybe wait till 75, you get the most. That would make sense. But that is the third rail of politics, because if I was running for Congress and I stood up and I gave all these I had graphs and projections, I gave all these great mathematical reasons why this is the right thing to do, somebody's going to come up behind me and say, he just said he's going to cut Social Security. And then that's it.
Right.
That's the statement, period. That's going to be on every commercial, on every mailer, and I'm going to lose.
Right.
So I think you're right. I think it's going to fall on the workers for sure. I even think it could be adjusted through marginal tax rates, right? Because we could just start, and that's so Chris, that's what we're planning for. I think it's wise to have an idea of, well, what if my benefits get cut? I don't think it's likely, but what's probably more important is to start a tax efficient plan to potentially shift your investments over to something that is not ever taxed again, like Roth IRAs, things like that. So really great question though, Chris.
Yeah, it is a great question. Should I go to
All
the
right.
next one?
What's that?
Should I go to the next one?
Yeah, sure. Go ahead.
The 8.7% COLA increase in January 2023, which if you didn't know that, hopefully most people know that was the COLA that we landed on. That will be in effect with the December payments that will be paid in January 2023. Does it affect current benefits recipients only, or it will affect future benefits as well? If one applies for benefits in February 2023, for example, will he or she be getting the increase by the 8.7% amount? That's a great question as well.
Great question, yeah.
Anyone who is eligible for a benefit, what does eligible mean? It means that if you are 62 or older, then you are entitled to that COLA regardless of whether you file. Okay, so that's been a common question. So anyone who is collecting a benefit already, so whether that's an SSI, SSDI, Social Security Disability, a dependent, an auxiliary benefit, whatever the case may be, all of those folks are obviously going to see the increase in their January payment, as well as a retiree or future retiree that is at least 62, but not necessarily collecting it. So I got a lot of questions saying I have to run down by December and collect my benefit to get it. So the answer is yes, you will get it, even if you wait. If your plan is to file in February, you will collect the 8.7. It will have been applied to your primary insurance amount, because I'm assuming that you were 62 in December. So yes, you will get that.
Now, Heather, let's talk about, when we were at the conference last week, there was a question in the audience from a financial planner. And this person said, well, why wouldn't I take it, the 8.7% rather than waiting, because 8.7 is more than 8. Right. So that is not a dig to this financial planner, but it just goes to show you how confusing Social Security is, because why don't you talk a little bit about that? It's not one or the other.
Right. And that's the thing, I always say you're going to get the COLA if you're 62 or older, but think about this, the longer you wait, when you eventually file for the benefit, obviously you're getting a bigger benefit to which that COLA is being applied. So it does behoove you, because you're going to collect, your primary insurance amount, which is your calculated benefit, is you're going to get the 8.7 regardless of whether you file. But if you file at 62, for example, now you've locked in your permanently reduced benefit, and now your 8.7 is being applied to that benefit, versus in his question, he was thinking, I'm not going to get the 8% delayed retirement credit for waiting 12 months plus the 8.7. And I was thinking, no, you are. Yeah. So you're better off from an inflation hedge and a longevity hedge. We're all living longer to wait and get not only the 8% for the 12 months of delay, but also collecting an 8.7% bump on that to help pay for the exorbitant amount of inflation we've all endured the last year. So you have to be thinking about both. The 8.7 sounds great, kind of, but we've also been all painfully paying ridiculous amounts for last year. So
That's right.
the longer we can wait to lock in the higher benefit is a good thing, and also a bigger base amount that the COLA will apply to.
Yeah, I agree. And as long as it works in your plan. So it is individualized for everybody because
Right.
as Heather said, emotions have to come with this. Cash flow is really important, and Social Security is a guaranteed cash flow. So for some people, it makes sense to wait. For some people, it makes sense to take it at their full retirement age. I'll honestly tell you, I don't see many cases where it makes sense to take it before that, but I'm never going to say never. Really, really great question, Anonymous. I wish I knew your name so we could give you credit.
Yeah.
Okay. So Owen asked, personally, he asked, I am past full retirement age, but my wife is not. Are my benefits taxable?
Great
It's a
question. And
completely
that,
different question.
right, that highlights the confusion, right?
Yes.
So, Owen, is a great question. Taxes, again, are the gift that can keep on giving no matter how old you are. Really, what I think you're probably asking, and the confusion comes in with, if you're past full retirement age, if you were still working and claiming your benefit, you have no problem. If your wife was claiming a benefit and she was still working, you might have a problem with the earnings test. See, this is why these two concepts get confused.
Yes.
As far as taxes, there's a potential for taxes to always eat a part of the benefit. And maybe it would help if we kind of talked about taxes for a minute.
Yeah.
Okay. So to answer your question, Owen, there is no moratorium that once you hit full retirement age, you can say bye to Uncle Sam. That isn't the case, right? It's all going to be dependent upon your entire arsenal of retirement income and what that's made up of. So before we go on to another question, let's just kind of talk about, let me move this over so we can.
Yeah, I was going to say, do you have a slide on provisional income?
I do. Wow.
Oh, excellent.
Look at that. Okay, let me move this over so I can see it. So let's switch over and talk about income taxes and the benefit. And again, this is not something that goes away at any age, right? You can be 99 years old and this still could apply to you. When you're trying to figure out if any portion of your Social Security benefits for the year are taxable, you first have to figure out provisional income, which is a fictitious sort of formula to figure out. It's also sometimes called combined income. Provisional income or combined income are the same thing. And it's a function of these three things: modified adjusted gross income plus non-taxable interest. So things like municipal bond interest that aren't federally tax-free are pulled into this formula, plus 50% of the annual Social Security benefits received. So if you were married and both of you are collecting Social Security benefits, you take the total of all of those annual benefits and divide by 2. That is a part of this calculation. What does modified adjusted gross income mean? It means that we're not also calculating the taxable portion of Social Security that we've just figured out through this PI formula. So that it's kind of like we're not counting it twice. So adjusted gross income, what does that compute as? Well, all of the things that we said are not part of the earnings limit, because we only, that earnings test that we were just talking about, that's only earned income. All the other things we're now talking about. So let's name them, right? It's pension income, it's rental income, it's dividends, it's what all are they? I mean,
Interest.
It's
yeah.
Right. IRA distributions,
IRA
R&D,
distributions, right? Traditional
R&D,
IRA distributions, RMDs. Yeah.
all of those things that go into adjusted gross income are included here, plus non-taxable interest if you have that, plus half of the Social Security benefits received equals your provisional income. Once you have that figure, then you look at your threshold, or you go by your filing status and figure out where you fall in this, in the thresholds below. Now, here's what's frightening, is that Social Security Act of 1983 added taxes on the back end. So we paid tax into the system on the front end, but 1983 Social Security added taxation on the back end, and these thresholds have never changed since 1984 when enacted. So if you're married filing jointly and this provisional income total does not exceed $32,000, then you do not have to pay taxes on a dime of your Social Security. So you're going to keep all of it. If you're married filing jointly and you're somewhere between 32 and 44,000, then as much as 50% of the benefits can be taxable. And if you're above 44,000, as much as 85% can be taxable. it's not that simple. So don't think it's a cliff vest situation that you're at $44,001 and you're now paying tax on 85% of the benefit. It doesn't work that way. It's a graduated scale, but nevertheless, you can see that if you're single or married filing separately, it's slightly less. But it doesn't take a whole lot of other sources of income, taxable income, to create a tax, for an erosion of some of the benefit by taxes, right?
Yeah.
So that's the issue.
Yeah. And if I can comment on that. So Heather said a couple of things I just want to hit on. Every year we get an increase in Social Security. Most of the time, there's been a few very small ones and now some very big ones this year. But these tables have not increased since, what'd you say, 1984?
Yep.
Cool. Think about that difference, right?
Yeah.
So more and more people are falling into this provisional income calculation and paying up to 50%, up to 85%. And that's where you can tell, by the way, that Heather is a real professional here, because I've heard other people tell this story and they say, yep, $32,000 and $1 or $32,001, 50% Social Security is subject to tax. That's just wrong. It's a formula. You can do the calculation on the form that the IRS has, but more and more people are being subject to this tax, and more people will every year if they don't adjust the calculation, which they're not likely to do because they need more and more tax. And the problem is bigger than that, because if you have to pay, for example, $5,000 tax on your Social Security benefit, most people have done a lot of planning with the idea. They go to ssa.gov, they figure out how much their benefit's going to be. They plan on how to spend that, and then suddenly their combined $40,000 benefit is now $35,000, and they say, well, wait a minute, we wanted to spend $40,000. So now they take the $5,000 they were planning to spend out of one of their accounts, and most people have their money where? In IRA accounts. Okay. So they have to take money out of their IRA to cover the difference, but it's not just $5,000, it's more like $7,500 that you have to take out, because you have to pay tax on that. So you're paying tax on your Social Security benefit. A lot of people have to take additional funds out of their IRAs, pay tax on that. And the snowball on that, if you're not catching it now, just what happens is they're taking money out, and their money potentially runs out sooner than they would like, or maybe they have less to pass through their heirs. And it's a real planning issue that most people aren't paying attention to. Right. So I find that most people aren't paying attention to the concern about taxation of their Social Security, IRMA, income related monthly adjustment amounts, lifetime IRMA for people, and out-of-pocket costs of Medicare, additional expenses. But these are kind of the big three that, unless you're already in it, collecting your Social Security and paying tax on your Social Security and potentially paying additional amounts for your Medicare, and you're 59 and trying to do some retirement planning, you're probably not even paying attention to this. So good for you folks that are listening tonight.
Yeah.
I'll get off my soapbox now.
Yeah, well, no, I could go all day about it. So that's why, when I said it's no one size fits all approach, and it's also not something that you can decide I'm going to claim just because, water cooler Joe told me to do it. It's really, you really do have to look at everything and say, okay, what is the most tax efficient way to claim Social Security too? I mean, you're looking at a lot of things like, what other sources of funds do I have? If everything you have is in a pre-tax 401k that you roll to an IRA, then perhaps that's going to come into when the best time to claim is, in a way, because is there a possibility that we could draw down some of that before you take Social Security to help it be more tax efficient and also preserve a higher survivor income for, maybe there's a disparity in income benefits between the spouses. There's so much that goes into it, which is why I'm passionate about it. You're passionate about it, and there's very few sources of income that don't hit that PI formula. And they are, you've mentioned one, qualified Roth distributions. I'm always like, if we can do some pre-planning before we hit that Social Security on button, it's nirvana for me and you. So you got qualified Roth distributions, you've got certain, distributions from life insurance policies, health savings accounts, which I am a big fan of. I'm like, max out your health savings accounts if you can. It's a way to pay long-term care. Now you got to stop doing them when you get on Medicare, FYI. You cannot contribute to an HSA, high deductible plan, HSA, once you're on Medicare, and that gets people, they'll make you take it out. But those are all things that when you take qualified distributions out of a HSA, that's tax-free. There's very few things that you can take and not hit the PI, or not, not have it make Social Security taxable. And that's why you can't look at Social Security claiming without looking at all of that to say, okay, well, it's one thing to say, well, this claiming age makes sense from, this perspective of when we need to take it for what makes sense to us. But if we're not looking at the tax component, it comes with surprises that you really don't want.
Yeah. And you mentioned earlier, reverse mortgages when we were talking offline.
Yeah.
And that's something that's becoming more and more popular, even with air quotes, the wealthy folks, because it used to be, and I had this belief too, that's kind of if your back's against the wall and that's your last asset, but it can make a lot of sense for a lot of people to set up a reverse mortgage line of credit, draw on that, very much like how you draw on a life insurance policy, and it's not taxable. So you need these things, because even if we went back, can you go back to the provisional income section real quick for me? Something else people also don't consider, if you're a husband and wife going into, or a married couple going into retirement together, they also, everybody knows it, but they don't think about the suddenly single, right? One of you is likely going to pass before the other. And not only do you get hit hard from a tax point of view, because now suddenly your tax brackets change dramatically and not in a positive way, but now to be tax-free from Social Security, if you could be below 32,000, you might be struggling to be below 32,000. Now suddenly you got to be below 25,000, and that's much, much harder, because usually a spouse inherits an IRA. You have still those required minimum distributions. You have zero control over how much is required to take out of those IRAs. The IRS tells us exactly what has to be taken out. There are some things you can do around that, but it's important to know. So, okay, Heather, I'll let you continue.
Well, I think we should answer some of these questions. One thing I didn't say that I want to say, because I think we talked about, being mindful about break evens. That was one of the things that I think we said, let's talk about. One of the things that a lot of folks don't understand when working with married couples, everyone says, what's my break even? First of all, we all know that everyone's living longer. But one of the things that a lot of folks that I've worked with, or through financial advisors, Mark, like you, that we're working with couples, they don't quite understand how survivor benefits work. And so when I see a couple that particularly has a wide disparity in benefit amounts, and that happens quite a bit, women, I'll use myself as an example. I was kind of in and out taking care, we take care of people. That's just kind of typically ends up what we do. And so we might have a disparity in income benefits. And so you have to think of break even from the standpoint of the couple, not singly, because if I'm going to look at sort of rules of thumb, and I really don't have rules of thumb, I'm never going to tell you everyone should do anything. But if I'm looking at a couple, I'll say, let's leverage or harvest that higher wage earner in terms of when they claim. And again, we all have an emotional component to this. We're like, I have paid into this. I have finally retired. I want to go buy a boat, or I want to have the spending money. I get that. But from a break-even standpoint, or what makes sense, remember that from a survivor standpoint, what the higher wage earner does is a gift that can keep on giving or not. What I mean by that is when one of the two dies, whether it's the higher wage earner or the lower wage earner, what happens? The lower benefit goes away. So if that higher wage earner decided to file at 62, for example, that's what the survivor is going to get. Now there's something called, there's a spousal protection a little bit when someone files at 62 that bumps that benefit up slightly. But by the same token, if someone waits to full retirement age, the higher wage earner waits to full retirement age, or even to age 70, that survivor inherits that higher benefit. And so you have to really think about that when you're claiming, particularly when there is a wide disparity of income benefits, because I don't know that many spouses that say, I don't care what happens when I'm gone. They don't say that. Maybe some of you do, but I doubt it, right? You are concerned about income,
right,
for the survivor. And if you don't have, there's a health event, you don't have a life insurance to replace that, this is the insurance. Because the reality is, we know that expenses don't go down by 50%. They don't. And so you want to make sure that when you're thinking in terms of break even, you're thinking about the longevity of the couple. You're not, and the reality is that like there's more than a 50% chance that one of you is going to be alive at 90.
Yeah.
Okay. Average life expectancy is 84 for a male, 87 for a female, but there's a 50% chance somebody's going to be around at 90.
Yeah.
Right. So you have to think about that. So I always say, hey, listen, if we're going to sacrifice the lamb, let's sacrifice the lower wage earner to file earlier and hold out as long as we can for the higher wage earner. That's my only rule of thumb. And like you, Mark, if we can get to full retirement age, by all means, please, because Social Security says, we make the formula so that whether you file at 62, full retirement age, or 70, it's all the same based on life expectancy. They haven't updated their life expectancy model since the 80s. Okay. That is not true anymore. That's not true.
Mhm.
So you really need to be thinking about that and work with somebody that can help you sort of look at all of the variables.
Yeah, and it's so much more than, we all have different software we use as professionals, and it's so much more than those software outputs. So Heather and I were talking about this last week because some people, they do these free evaluations of your Social Security, hand you that, and the software tells them this is the best way to collect your Social Security, how they get the most amount out of the Social Security Administration, but it doesn't consider cash flow, it doesn't consider taxes, it doesn't consider these other nuances that are just so important to the overall plan. All right, so Heather, why don't we go through and answer some of these? We have a lot of questions and we've got about 10 minutes left if we're going to stick to the hour. So unfortunately, we won't be able to answer all the questions, but if you want to schedule time with me, we can go over your questions. So why don't we look at Eileen's? Eileen asks, you plan to take retirement at age 70. This is an easy one. How far ahead should you apply?
Eileen, you can apply up to 4 months early. I highly suggest doing it online. It's the easiest way to do it. And, good luck if you try to go into the office. It's kind of a headache right now. So you can do it online. Just make sure you have all the information you need in front of you. You can actually go onto the Social Security's website, and if you Google search or not Google search, if you go into their search function, type in what I need to apply, there's a list that shows you exactly what you need, but that's the easiest way. I also tell anyone that goes online to apply, there is a remarks section at the very end of that application. Restate what you said. If you said, I'm filing my application to begin the month I turn 70, restate it so they can't misinterpret what you're doing. Always restate what you're doing in the remarks section.
And what do you think about when the representatives remind people that they can go back 6 months, collect benefits, retroactive 6 months, and take a big, chunk of money, so to speak?
Yes, they do that. It's funny that you say that. They do sometimes remind them they can do that. I mean, okay, so you can ask for 6 months of retroactive benefits. Here's the upside of that is you get 6 months of lump sum. The downside of that is if you get it, of course, they're going to recalculate your benefit and reduce it for the fact that if you did that at 70, in Eileen's case, say she said, in her remarks section, I'm filing now at 70, but I want retroactive benefits for 6 months. Well, now they're going to recalculate her benefit as if she had filed at 69 in 6 months. So she's going to get a reduced benefit for the rest of her life. Does that make sense? Maybe not if she lives to 90, right? So they do, and sometimes remind people of that. And it's probably because they're saying, well, it's better for us to pay you the 6 months of lump sum than it is to take the chance that you're going to live to average life expectancy, because even average life expectancy, mathematically, it makes more sense to file at 70. So be careful of doing stuff like that. Make sure it makes sense for you.
So let me ask Jeff's question. It's a 3-part question, but I think it all runs together. So Jeff, first of all, good to see you. So if one spouse made a lot more than the other, is it possible? So higher earning spouse, you touched on this a bit. I think maybe you might have answered it, but let's just make sure you did. If one spouse makes a lot more than the other, is it possible for the spouse who made less to take 50% of the higher earning spouse's benefit?
Great question. And we didn't talk about this a lot. So for anyone to take a spousal benefit, the first critical thing is that spouse, the wage earning spouse or the higher earning spouse has to file. That's number one. Can't take a benefit without the worker spouse filing, number one. Number two, absolutely. If the lower earning spouse has their own retirement benefit, there's something called deemed filing. And that means that anybody who has earned their own retirement benefit is always going to get paid their retirement benefit first and foremost. Okay. If they were born after January 1st, 1954, that's just how it goes. But let's suppose that your spouse files, she has a negligible benefit, and you file for your benefit also. Then absolutely, if 50% of your benefit is higher than her own retirement benefit, they'll top her retirement benefit off with the additional spousal excess benefit to bring her to the higher benefit. Now, whether or not she gets the full 50%, and it's always 50% of your full retirement age benefit, irregardless of when you file. You may file at 70, it's not going to be 50% of your age 70 benefit, nor is it going to be 50% of your 62 benefit if you file early. It always starts at 50% of your full retirement age benefit. Whether or not she gets the full 50% depends upon when she files for it. So it's reduced for her age. Now, she also doesn't get benefit for filing for it after full retirement age either, because she doesn't earn delayed retirement credits for spousal benefits. But absolutely, if the spousal benefit produces a higher benefit than her own, she can absolutely have that higher benefit. You just have to file for a benefit first before she could collect it. That's a great question.
That is a great question. And you talked about this last week, but this is important. There used to be this file and suspend. And so the higher earner could file for their benefits, then suspend, and then the spouse could collect on the spousal benefits and let theirs continue to go. So file and suspend is done with. Right?
Well, that's what I was saying to Jeff. You got to file for a dependent of any variety. If you had small children that could file, a spouse, you have to file before that dependent benefit can be paid. That was the file and suspend that I'm talking about that went away. It used to be that Jeff could file, immediately suspend, and then his spouse could file, and he could continue to earn delayed retirement credits. That's gone, gone, can never be done again. What's still here, which we could do a whole nother hour on, but what's still here is for people that were born before January 2nd, 1954. So if you were out there and you're now 69, okay, or turning 69, then you have an additional option. I won't spend a lot of time on it, but if that is you, then you do have an option of, in certain circumstances, to file only for spousal benefits and let yours continue to grow. So if you were waiting till 70, haven't filed for your benefit yet, and you're married to someone who has either already filed or is willing to, then there is an option to do that. So the critical ingredient is, if you were born before January 2nd, 1954, then you need to call Mark, and we'll talk through that. Yeah. But for most of us that are probably on this call, we weren't. That isn't the situation. We didn't talk about divorce benefits. If you were married for 10 years or more, then same rules apply. You may be able to collect benefits from a former spouse while they're living. Again, the same 50% of their full retirement age benefit. If it's greater than your own retirement benefit. The only difference there is they don't necessarily have to have filed, as long as they're at least 62 and your divorce occurred at least 2 years prior to your claim. You could possibly collect that benefit again if it's larger than your own retirement benefit. It's a lot of information.
It's just, again, 565 ways to collect Social Security, and that's not the actual number. I'm making that up, but it's probably close. So okay, Ken asks, this is a kind of a layup, is Roth interest earned considered non-taxable interest? And I think Ken is referring to the provisional income calculation. So I'll let you take that.
Ken, that's a great question. And no, for that purpose, we're talking about non-taxable interest, like municipal bond interest that would normally be federally tax-free. Roth interest, or the tax deferred growth, totally separate category. And if it's a qualified Roth distribution, that's in the IRA category. If it's a qualified Roth distribution that has been held for 5 years and meets a qualifying event like 59.5, which is your normal one, death, disability, or first-time home purchase, usually it's 59.5, then that's a tax-free distribution of the gain as well. Then that would be completely separate and would not be part of provisional income. So it would be tax-free.
Yeah, great question, Ken. Gerard asks, is there a proposal to remove the 85% tax on Social Security entirely and raise the contributions on income to $250,000 to help sustain the Social Security fund?
So I haven't heard the proposal to remove to make a Social Security possibly 100% taxable. I haven't read that one. I've read a lot of proposals. Maybe I've missed that one.
Yeah.
I have heard to raise the contributions on income to 250. I've heard the FICA tax being reinstituted at 400,000 for singles and 450 for married. I don't know, Mark, if you've heard anything different. That's one I've heard repeatedly, is reinstituting the FICA tax on.
Right.
So having sort of a donut hole, like, it's right now it's at 147. Next year it's going up to, what's it going up to next year? I think 160, 160,200.
Yeah.
And then it would go up back. Then it wouldn't be taxed, and they would reinstitute the FICA tax on $400,000 or more. The other thing I've heard is, kind of going after business owners, in particular S corporation owners that, might be showing very little W-2 income and doing passive income, and maybe sort of looking at them and saying you have to show more W-2 income because only the W-2 income gets taxed under Social Security. Those are the ones that I've seen most in the FICA tax category.
Yeah. Yeah. Good question. So let's we're at 7:30. Tell me, Heather, you want to go on another 5 minutes, or do you have?
Sure. I mean, if they want to go on, we can go on.
Okay, so let me ask this. So Keith asks, and this is kind of a big one. So does the family max for Social Security, because we haven't even talked about this, does the family maximum for Social Security go up by the COLA percentage as well?
Question. Yes, it does, because all the benefits within that family maximum. So if you don't know what the family maximums are, when you have more than, and this can be convoluted, but if you have more than 2 people on one benefit record, so if you have, for example, a worker, a spouse, and a child, you're dealing with a family maximum, meaning you can only have so many people on one record before exceeding a family maximum. So if you're talking about a retirement benefit and a couple of dependents, it's typically 150 to 180% of the primary insurance amount of the worker. It's very different for disability claims. It's a lot more stringent, but irregardless, each of those benefits that are being paid absolutely gets the COLA. So yes, the answer is yes. They do all get the COLA within the family maximum.
Doug, we kind of answered this one, but Doug asked, when your spouse dies, the surviving spouse doesn't continue with both benefits, the surviving spouse gets the higher benefit.
Correct. So what in theory happens there, Doug, is no, they don't get the collective total of both. So when one spouse dies, they don't continue to get both benefits. What happens is if both spouses had earned their own retirement benefit, then technically what happens, let's say the higher wage earner dies, the lower wage earner continues to get his or her lower retirement benefit, but then it's topped off with the higher earner's remaining survivor benefit so that the collective amount is the higher benefit. So that's how it actually works. They get a dual, it's like a dual entitlement. That kind of confuses people, but anytime anyone has a retirement benefit, it always continues to be paid. And then they're topped off with either a spousal benefit while the spouse is living, if it's a higher spousal benefit, or a survivor benefit. But yeah, they do get reduced by the lower benefit amount when one person dies in the marital relationship.
Yeah. Yeah. And it is, so it gets a little confusing in the details, but $3,300 is $3,300, right? I mean, if that's
exactly
that's
right.
the higher
Right.
benefit, right? So Doug asks another question, and I'm just going to rephrase it a little bit to make it a little clearer. Does it make sense for a spouse to take a spousal benefit, if eligible, to allow the benefit of the other spouse to increase?
So I think what that question is, Doug, is can I choose, maybe I'm misinterpreting it, Mark, so you can tell me, or Doug, either one. Can I take a spousal benefit so that I can let my own benefit grow? Is that maybe what you're asking?
Can one spouse take a spousal benefit and allow the other spouse benefit to grow? It's kind of what we talked about just a few minutes ago.
Like restricting an application.
Correct.
You can't do that unless you were born before January 2nd, 1954. So that's the thing. I always say, like you were taught in kindergarten, you get what you get and you can't pitch a fit. That's kind of what deemed filing is.
Yeah.
Now you can't choose to take only that benefit, not that one. So spousal benefits are still alive and well for someone who is married. First of all, you have to be married for 1 year to get spousal benefits, 9 months to get survivor benefits. I can collect a spousal benefit if either I am a very low earning spouse or a completely dependent spouse, meaning I never earned my 40 credits. I can still get them. But if I have earned a pretty decent retirement benefit of my own, let's say my benefit estimate at full retirement age is $2,000, I'm forfeiting my spousal benefit because my full retirement age benefit is higher than the maximum spousal benefit could be. Because right now, I think well, I can tell you, hold on. The maximum full retirement age benefit this year is, if I can lay my little eyeballs on it, $3,627. So someone turning full retirement age this year would be roughly $3,600, right? So half of that, what's half of that? I can't do my math right now because it's been a long day. What's
There
that?
was 3,600, 3,625,
Yeah, what's half of that?
1812.
There you go.
18,
There you
12.
go. I couldn't do my math. Thank
Yeah.
you for doing the math.
I
So
go to my calculator. I don't.
Oh,
I
good,
learned that
okay.
in the CFP course. I never do.
There you go.
Yeah.
so if my PIA, if my full retirement age benefit is 2,000 and the maximum right now, the maximum spousal benefit is 50% of that, right? Then I know that I'm going to forfeit a spousal benefit while my spouse is living. So there's no point, I mean, or even an ex-spousal, if you're thinking, oh, well, I was married, to somebody years ago, is it worth going to see if that benefit's higher? Well, if your benefit is 2,000 or more than 1,825, then that's not worth going through the hassle of figuring out if that benefit's higher. Now, if that former spouse passes away before you, now we're talking a different story, because spousal benefits while living and ex-spousal benefits are only worth 50% of their full retirement age benefit. But what happens with survivor benefits? They are worth as much as 100% of what the deceased spouse or ex-spouse was collecting or entitled to collect at death. That's a different story, right?
Yeah.
So then we're talking about a potential increase there. So, you have to kind of look at the numbers, and we could talk about this for hours. I could talk for hours. I mean,
Yeah,
after being my
I have to
husband.
tell you, there's so many things,
Yeah.
and there's so many nuances.
Yeah.
Great question.
Tom, you have a question.
John said, Heather is amazing, all in caps, with
Oh.
4 exclamation points. So great. You're right, John. Heather is amazing.
Well, thank you,
She's
John.
a great resource for us, and she's very giving with her information as well. Jeff says, thank you. Ken, I see this question, and I'll read it out loud to see if I can understand it. It says, if you wait to 70 to take Social Security, can you sign up for full Social Security and then defer to start at 70? And I'm sorry, I'm not understanding that. So maybe if you want to retype it, and maybe we answered it already, I don't know, but I'm not quite understanding. You should be able to see that, Heather. Can you
see it. I mean, you don't really have to do that, Ken. I mean, you don't really have to do anything at full retirement age. Simply by doing nothing, you're automatically deferring and earning delayed retirement credit. So you don't really have to do that. Now, if you wanted to, say you had already filed and you're like, I wish I hadn't done that because I listened to this amazing discussion tonight and I learned that I could earn so much more had I not. You can say you'd already filed before full retirement age and you don't want to pay back the benefits because you don't want to pay back 12 months worth of benefits or whatever. You can suspend your benefits at full retirement age. You can't do it before, but you can suspend your benefits at full retirement age, contact Social Security and say, stop paying me, and then earn delayed retirement credits for the amount of time you suspend before you contact Social Security and tell them to pay you back. Now, you don't want to do it past 70, but then you have earned delayed retirement credits during the suspension. You could do that. You don't want to do that if you have a dependent on your record, because then they'd be suspended too. But that's a flip side of that question. I don't know if that was.
Yeah, I'm glad you mentioned that last part, because that's going to get people thinking about, well, then I can do that file and suspend. But the big difference is what they did is they coupled the benefits of your dependent along with that. So if you suspend, then your spouse or other dependent is suspended.
Yeah.
All right. This is the last one.
Okay.
Tom writes, thanks, Heather and Mark. I'm 67 in 5 months and have not yet started Social Security benefits. When projecting the 8% future earnings increase per year for waiting to start taking benefits, the online SSA.gov resulting graph that is displayed shows a linear or incremental increase per month. But when I click on a particular month, it shows the same benefit dollar amount up to 11 months and only shows the 8% increase once per year.
Okay, so you can't look at I think you're talking about my Social Security account, maybe.
Yes.
Yeah, you can't. First of all, the they're not showing the 8.7 on your benefit estimates. I'll tell you that. And I had to look at this one time and I'm trying to remember because it has something to do with, the statements are weird and I can't remember, Tom, exactly, because it drove me nuts because someone was saying it was dependent upon when their month of birth fell, because like they said, I had like a big leap from like 67 to 68 and then a negligible leap from 68 to 69. And I had to like, it drove me nuts until I figured out why. And now I'm trying to remember what it was. But the first thing to tell you is the Social Security benefit estimates don't show the increase. All they do is use the bin points for the current year when they do the recalculations. So they get pretty accurate the closer you get. Like in your case, you're in the realm of filing, so they're pretty accurate. But they are using estimates based upon the bin point formula for the year of the estimate, and they're using the most recent year of earnings. That's kind of a mumbo jumbo to end this night on, but they're not using a projected 8.7 exactly on those estimates. And I don't know if I'm answering your question, but it was wonky. The way that those benefit estimates has something to do with your birth month and how they calculate it. I don't. This is a bad
I
one.
think I think they're all good. That's a great explanation. I would say the short answer is from somebody who was in government for many, many years. It's a government website and it's going to have significant limitations. Yeah.
Yeah. It all comes out in the wash, but it has something to do, like when you look at the actual numbers from your full retirement age to 70, it all made sense collectively, but it was weird the way they did it. And I had to look at it and I'm like, why are you confusing people? It was just weird how they did it, but I understood it once I actually physically looked at the statement. But yeah,
it is surprising how it does come out pretty darn close to it. It just shows you how many, many years of working really drives the calculation, because, you know, maybe you might be correcting me in a second, but my understanding is that the calculation on SSA.gov assumes that you're working until your benefits are collected, right?
It does.
But many people, of course, they may stop working at 65 and they don't collect until 68, 70 years old.
And that's exactly why you need to go in there and go to the plan for retirement tool in your My Social Security account and stop working. Show that, because you can do that. You can slide it and say, I'm stopping working, and then I'm going to take my benefit, and it will actually project out a different estimate for you. So it's a great tool. You all need to be in there going into my Social Security account every year.
Yeah.
My public service announcement.
There you go. That's a good thing to wrap it up on. All right, folks. Well, this has been a little bit longer than we anticipated. So we're coming up on, we're a little over an hour and 12 minutes, it looks like. Heather, thank you so much for your time. It's always a pleasure to see you. Why don't you stop sharing your screen so we can see your lovely face before we log off. But so much great information. I'd love to have you back maybe early next year so we can kind of recap and catch up on things and do an encore event. That would be a lot of fun, and I think our folks would really enjoy it. But everybody, I appreciate the questions. Heather, I appreciate the time. And if there's nothing else, we'll see you at our next webinar.
All right, sounds good.
All right, take care.
Take care.
All righty, bye-bye.